Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence.
We got a few good hints from Fed Chair Powell about Fed's thought process. They believe that if they wait for inflation to reach 2% before any rate cut, they have waited too long. There seems to be more of a balance. Fed has seen inflation come down. They have also seen weakness in job market. So they seem to think that the policy is restrictive, but not severely restrictive. While it didn't entail any major reaction from markets, these are important hints to understand Fed's thought process. Morning, JK. Given yesterday's Powell's statement, does it change any narrative for the market, especially since two rate cuts have already been priced in for quite some time?
Good morning, Swaraj. Yes, I would call Powell's statements yesterday more dovish than his testimony to the Congress last week. So he recognized that we are moving more into the balance, and also he expressed more confidence on inflation getting back to 2%. He also said that he is not going to wait till inflation hits 2%, which means that rate cuts are on the cards, and September rate cut is not very unrealistic. But if you look at the markets, different markets have taken it different way. Stock market obviously positive because they are looking short term factor that the yields will be lower and rates will be cut, and that's good for the corporate. And the earnings season is also not bad. Most of the earnings have been on the positive side. But if you look at the bond market and the currency market, they are in a very indecisive state because while Powell's statement, weakness in the economy, all these indicate a rate cut, the chances of Trump coming back to power is actually overshadowing these factors because there's an overwhelming consensus that if Trump comes back to power and his policies of tax cuts, immigration restrictions, and also China tariffs, all these will push the deficits higher and also inflation higher, which means yield will not come down much and the dollar will be higher as well. So there is a kind of dilemma in which the bond traders and the currency traders are, and that's why you see them trading in a range. If you look at the specific markets, Euro failed to break through 1.0920, which is a strong resistance. The rally so far was held by higher yields in Germany, but that has now slightly come down. Yen taking heart, yen bears taking heart from the move up in US yields in long-term tenors. That's again supporting the dollar there. Chinese data, very dire GDP numbers yesterday. Again, at the same time, Chinese authorities not doing much on the policy, is keeping the yuan on the weaker side. Not so much near the recent lows, but still on the weaker side. And of course, the commodity currencies also took some hit because of the Chinese growth being lower than expected, much lower than expected, in fact. So if you look at the data also, as I said, Chinese data coming lower and then followed by Eurozone industrial production also coming weaker. The Empire State Manufacturing in US also coming at -6.6 versus -6% expected. So all these are actually a dampener as far as the growth picture is concerned. Hence, the impact has been felt on the sentiment, which of course is more expressed in terms of gold, which has gained yesterday, but currencies are still undecided because of the Trump factor, which is becoming now a bigger thing. In India, we had the trade data, which came somewhat narrowing on the trade deficit by about 2 odd billion, because both the exports and imports were falling. but imports fell much more. Good news is that we have achieved 200 billion, over 200 billion exports for the first quarter, April, June of 2024, which means that we are on target to achieve 800 billion export set for FY25, and that's a very good development because exports being highly employment intensive, and at the same time, while we are following the Make in India and import substitution efforts, eventually we should have a substantial positive impact on the trade deficit. So that's good news from Indian perspective. WPI came higher, not a surprise because food inflation has been higher. So it was already seen in the CPI as well. But nothing concerning and nothing that influences the RBI's monetary policy, which will be held steady at current rates for quite some time. So the rupee was not seen, gaining from any of these data because the demand continues at slightly elevated levels, and if dollar index moves higher after having seen strong support, I feel the rupee may be poised for testing slightly higher level at 83.65, provided the central bank is not averse to such a movement. Thank you.
Thank you, JK. And just quickly summarizing the political scenario in the US that has been playing out amongst the currency and bond traders. A Trump victory might lead to wider deficits and higher inflation as tariffs are imposed, as further tariffs are imposed on China. Powell's statement yesterday was more dovish than his congressional testimony, but it seems rate cuts are definitely on the cards. And essentially, if we look at the growth numbers around the world, whether it is China, Eurozone, or the US, they have been hit, and that's something markets would be keenly looking at. Domestically, India's trade deficit saw some narrowing by $2 billion. Import fell much more than exports, and we are definitely on track to achieve 800 billion in exports for this financial year. WPI inflation was higher, but rupee did not gain from any of these, and demand for dollars have continued. Maybe a higher dollar index might lead to rupee weakening to 83.65, 83.70 levels, as JK mentioned. That's it from us today. Thanks for listening. Tomorrow is a market holiday on account of Muharram, so we'll see you all on Thursday with the latest in the financial markets. Thanks for listening.